China just weaponized silver, a $100 price target. Confirmed the battle lines have been drawn, and what happened on January 1st changed everything. China just made a move that most Americans don't even know is happening. A move they perfected back in 2010, when they took control of rare earth metals, and prices exploded by 4,500%. Now they're doing it again. But this time with silver. 60% of the world's refined supply under Beijing's control, 4 consecutive years of shortages, and a $100 price target that analysts say is now inevitable. The clean energy transition, the defense industry, they all run on one metal. And China just became the gatekeeper. This isn't speculation anymore. This is economic warfare. And most people have no idea it's already begun. Welcome to Economy Teller, where we decode the financial moves that shape your tomorrow. If you've been following global markets for years, if you understand that real wealth is built on real assets, then you're in the right place. Do us a favor, would you? Hit that subscribe button, because the stories we're covering aren't making headlines, but they're making millionaires and breaking unprepared portfolios. And drop a comment below. Tell us where you're watching from today. New York, London, Mumbai, Singapore? Let's see how far this community reaches. Now, let's talk about what China just did and why your financial position may depend on understanding it. On January 1st, 2025, while most of the Western world was celebrating the new year, China quietly implemented a policy that would reshape the global silver market forever. The export restrictions that took effect that day were not announced with fanfare or dramatic press conferences. They were simply activated. And in that silence, a new chapter of economic warfare began. The rules are deceptively simple. Only large, licensed, state-approved companies can now export silver from China. These companies must have an annual production capacity of at least 80 tons. They must maintain a credit line exceeding $30 million, and most importantly, they must have Beijing's approval. Out of hundreds of small and mid-size exporters who once supplied the world with refined silver, only 44 companies made the approved list. The rest were locked out overnight. These smaller firms were not insignificant players. They were key suppliers to industrial users and silver refiners across Europe, North America, and Asia. Their absence from the market is already being felt. An unnamed industry insider, quoted by Chinese state media, described the shift clearly. The policy elevates silver from an ordinary commodity to a strategic material. It places silver export controls on the same regulatory footing as rare earth metals. And anyone who remembers what happened with rare earths understands the implications immediately. China controls something that few in the West fully appreciate. The country ranks second in global silver mine production. But mining is only part of the story. What matters more is refining capacity. And here, China's dominance is absolute. The country controls between 60 and 70% of the world's refined silver supply. This is not market share that developed organically. It was built deliberately over decades. According to the London Bullion Market Association, China is home to 27 accredited silver refineries. Japan, the second largest refining hub, has only 13. The gap is enormous, and it gives Beijing something invaluable: leverage. The numbers tell the rest of the story. Through the first 11 months of 2024, China exported 4,600 tons of silver. During that same period, imports totaled just 220 tons. China is not hoarding silver because of scarcity at home. The country is absorbing global supply, refining it, and controlling its release back into the market. That makes China the gatekeeper of refined silver supply worldwide. The United States has begun to recognize what is happening. The U.S. Geological Survey recently designated silver as a critical mineral. This designation was not ceremonial. The USGS Critical Minerals List, established in 2017, guides federal strategy, investment decisions, and mine permitting processes. Silver now sits alongside lithium, cobalt, and rare earths as materials essential to national security and economic competitiveness. But recognition and action are two different things. While Washington adds silver to lists, Beijing is executing a strategy, and that strategy has a proven track record. China also imposed export restrictions on tungsten and antimony, elements critical in defense technologies. These moves are not isolated. They are part of a broader geopolitical playbook. Analyst Faisal Amin observed that China uses export controls to secure domestic industrial advantage and global pricing power. The language is academic, but the meaning is clear. Control the supply, control the market, control the market, control the industries that depend on it. The weaponization is already underway, and it is not theoretical. It is affecting pricing, availability, and the strategic calculations of governments and corporations worldwide. Silver is no longer traded purely on supply and demand fundamentals. It is now traded with geopolitical risk priced in. Market analysts are watching the $100 per ounce level closely. Some believe it is inevitable before the year ends. The factors driving that projection are multiple: structural supply deficits, industrial demand growth, monetary instability. But the new variable, the one that changes everything, is China's export control architecture. This is not the first time a resource has been weaponized. The United States weaponized the dollar against Russia following the invasion of Ukraine. Sanctions, swift exclusions, asset freezes. These were financial weapons deployed with precision. But they came with a cost. Trust in the dollar eroded in certain regions. De-dollarization accelerated. And now, other nations are learning to use their own advantages as leverage. China learned that lesson well. And silver, it turns out, is the perfect weapon for the economic battlefield of 2025 and beyond. The battle lines are drawn. The players are positioned. And the market is beginning to understand that what happens next will not be determined by miners, refiners, or even investors. It will be determined by Beijing. In 2010, a quiet transformation began in global manufacturing. It started not with explosions or military actions, but with paperwork, forms that needed approval, licenses that required processing, quotas that somehow never quite matched demand. And by the time Western executives understood what was happening, it was already too late. China had weaponized rare earth metals, and the playbook they used then is the exact same playbook being deployed against silver today. The story begins with a single statistic. In 2010, China controlled approximately 97% of the world's rare earth element production. These materials, neodymium, dysprosium, lanthanum, and others with names most people cannot pronounce, are essential for modern technology. They power the magnets and electric motors. They enable the precision of guided missiles. They make smartphones possible. Without them, advanced manufacturing simply stops. Beijing did not ban rare earth exports outright. That would have triggered immediate international backlash. Instead, they introduced licensing requirements. Export quotas were established. Environmental regulations were tightened. On paper, everything looked reasonable. But in practice, supply began to tighten, approvals slowed, shipments were delayed. And prices? Prices began to climb. Between 2010 and 2011, rare earth prices skyrocketed by 4,500 to 800%. Not a typographical error. 4,500%. Neodymium oxide, used in high-strength magnets, went from around $15 per kilogram to over $300. Dysprosium oxide surged even higher. Manufacturers across the United States, Europe, and Japan watched their input costs explode overnight. The effect was surgical. Western companies that had spent decades outsourcing rare earth processing to China suddenly found themselves completely dependent on Beijing's goodwill. Supply chains that seemed efficient and cost-effective revealed themselves as strategic vulnerabilities. Engineers scrambled to find substitutes. Executives flew to China for negotiations. Governments held emergency meetings. But the lesson was clear. China had not seized control through force. They had seized control through patience, investment, and strategic planning. While Western nations focused on financial engineering and service economies, China had quietly cornered the market on materials that make the future possible. One market analyst described it perfectly. This was not dramatic warfare. This was bureaucratic control. Death by 1,000 forms filed in triplicate. The phrase sounds almost humorous until one considers the implications. Entire industries, defense contractors, automotive manufacturers, renewable energy companies, found themselves unable to operate without Chinese approval. The response from Western governments was slow and fragmented. Some countries attempted to restart dormant rare earth mining operations. Others invested in research to find alternative materials. A few tried to build processing facilities outside of China. But every solution faced the same problem: time. Developing a new mine takes 10 to 20 years from discovery to production. Building refining capacity requires enormous capital investment and specialized expertise. And even when these projects move forward, they face environmental regulations, permitting delays, and community opposition. Meanwhile, China's infrastructure was already built, operational, and scaling. By the time the rare earth crisis entered public consciousness, the war was essentially over. China had won. Not through military conquest, but through economic positioning. And the victory was so complete that even today, more than a decade later, the world remains heavily dependent on Chinese rare earth supply. Now the same strategy is being applied to silver. The parallels are unmistakable. China does not need to ban silver exports to control the market. They simply need to control who can export, how much can be exported, and when approvals are granted. The 44 companies on the approved exporters list are all large, state-connected entities. They operate with Beijing's oversight. Their decisions are not purely commercial. They are strategic. The hundreds of smaller exporters who were locked out represented flexibility in the global supply chain. They were the companies that could respond quickly to demand spikes. They were the firms that provided options to buyers who did not want to depend entirely on state-controlled suppliers. Their removal from the market eliminates that flexibility. It concentrates power, and concentration of power is concentration of leverage. Charlie Garcia, writing for MarketWatch, put it bluntly. China just weaponized silver, and they did it while Americans were busy arguing about whether Bitcoin is real money. The observation is cutting because it is accurate. While attention was focused on cryptocurrency debates and stock market speculation, a fundamental shift in resource control was taking place beneath the surface. The rare earth playbook worked because few people understood what was happening until it was too late. The silver playbook is working for the same reason. Most investors, most business leaders, and most policymakers are not yet focused on export licensing rules from Beijing. They are watching interest rates, inflation data, and earnings reports. But the strategists, the ones who study history and recognize patterns, they are paying attention because they know how this story ends. It ends with higher prices, it ends with supply insecurity, and it ends with those who prepared early holding assets that everyone else suddenly desperately needs. The rare earth squeeze was not a one-time event. It was a demonstration, a proof of concept. And now the concept is being applied to silver. There's a truth about silver that most people do not understand. It cannot be created, it cannot be printed, it cannot be willed into existence by central bank policy or government decree. Silver exists in the ground, and extracting it is a process governed by geology, economics, and time. And right now, all three of those factors are working against supply. For 4 consecutive years, the world has consumed more silver than it has produced. This is not a temporary imbalance. This is a structural deficit, and the numbers are staggering. In 2024 alone, the market deficit reached 148.9 million ounces. That means demand exceeded supply by nearly 149 million ounces in a single year. But the problem runs deeper. Over the past 4 years, the cumulative shortfall has reached 678 million ounces. To put that in perspective, that deficit represents 10 full months of global mining supply based on 2024 production levels. The Silver Institute projects that 2025 will mark the 5th consecutive year of supply deficit. Some analysts believe the streak will extend to 6 years or more. And every year the deficit continues, the gap between what the world needs and what the world can produce grows wider. So the obvious question arises, why do mining companies not simply increase production? Silver prices have risen dramatically. The profit incentive is clear. New mines should be opening. Existing mines should be expanding. Supply should be flooding the market to meet demand. But it is not happening. And the reason why reveals something fundamental about how silver supply actually works. More than half of all silver mined globally is not mined for silver at all. It is mined as a byproduct of other metals, primarily copper, zinc, and lead. When a mining company extracts copper ore, silver often comes along with it. The silver is valuable, certainly. It contributes to revenue. But it is not the reason the mine exists. This creates a phenomenon economists call price inelasticity. Even when silver prices double or triple, copper mines do not increase production to chase silver profits. They increase production based on copper demand, copper prices, and copper market forecasts. Silver is secondary. It is extracted because it is there, not because it is targeted. Approximately 28% of global silver supply comes from primary silver mines, operations where silver is the main product. These mines are more responsive to silver prices. But they face their own set of challenges that make rapid expansion nearly impossible. Ore grades are declining. This means miners must process more rock to extract the same amount of silver. 50 years ago, a silver mine might have yielded 12 ounces per ton of ore. Today, many mines yield 3 ounces or less. The silver is still there, but it is more diluted, harder to extract, and more expensive to refine. Mining costs are rising across the board. Energy prices, labor costs, equipment expenses, environmental compliance, permitting fees. Every input cost in the mining equation has increased. And unlike other industries where technology drives costs down, mining technology improvements often just allow companies to maintain production levels from lower grade deposits. Then there is the time factor. The time factor is where hope dies. When a new silver deposit is discovered, the journey from discovery to production is measured not in months, but in decades. Exploration, feasibility studies, environmental assessments, permitting, financing, construction, commissioning. The timeline averages 10 to 20 years. Some projects take even longer. This means that the supply deficit being experienced today cannot be solved by new discoveries made today. Even if a world-class silver deposit were found tomorrow, it would not produce an ounce of metal until the late 2030s or early 2040s. The supply cavalry, as one analyst put it, is not coming. It is geologically stuck in traffic. In the United States, silver mining output increased by approximately 6% in 2024, reaching around 100 tons. On the surface, this seems positive. But zoom out, and a different picture emerges. U.S. mine output has been essentially flat for years. The 6% increase is a minor fluctuation, not a trend reversal. The structural supply deficit is now intersecting with another factor that makes the situation even more complex: substitution. There has been discussion in some circles about replacing silver with copper in certain industrial applications, particularly solar panels. Engineers have proven that copper can technically work in place of silver for solar cell conductivity. The science is sound, but the practical reality is entirely different. Converting a solar panel manufacturing facility from silver to copper-based production takes approximately 18 months. That is per facility. There are roughly 300 such facilities operating worldwide. The maximum parallel conversion capacity, assuming unlimited capital and perfect execution, is about 60 factories per year. Do the math. Even under ideal conditions, converting half of global solar manufacturing capacity would take a minimum of 4 years. And ideal conditions do not exist. Capital is not unlimited. Execution is never perfect. Supply chain disruptions happen. Technical problems arise. The transition, if it happens at all, will be slow and expensive. Meanwhile, solar manufacturers are not waiting. They have already absorbed a 180% increase in silver prices over the past year, and they keep buying. Why? Because they have no alternative. Panels must be manufactured, contracts must be fulfilled, projects must be completed, and the only input material available today is silver. Industry analysts estimate that silver prices would need to reach $134 per ounce before significant demand destruction occurs in the solar sector. That is the pain threshold. Below that level, manufacturers will pay whatever silver costs because switching is not yet viable. Defense applications add another layer of demand that cannot be reduced. Exact figures on military silver consumption are classified, but analysts describe the usage as significant. Missiles, radar systems, electronics, communications equipment all depend on silver's unique properties. And defense contractors do not have the luxury of substitution experiments. Systems must work. Reliability is not negotiable. So the equation is simple: brutal and unchangeable. Demand is structural and growing. Supply is constrained by geology, economics, and time. Substitution is theoretically possible, but practically years away. And into this already tight market, China has just inserted export controls that will further restrict available supply. The question is no longer whether silver prices will rise. The question is how high they will go and how fast. The future is being built on metals: solar farms that will power cities, electric vehicles that will replace combustion engines, defense systems that will protect nations, communication networks that will connect billions. Every piece of this future requires silver, and Beijing has positioned itself as the entity that controls access to it. This is not accidental. This is strategy. China's export licensing system is not designed to stop silver from leaving the country. It is designed to control the terms under which silver leaves. Approvals can be granted quickly, or they can be delayed. Shipments can flow smoothly, or they can encounter unexpected regulatory reviews. The power is not in saying no. The power is in making companies wait for yes. Western manufacturers who need silver for production are now facing a reality they did not anticipate. Their supply chains run through Beijing, and Beijing has leverage. That leverage extends beyond simple pricing. When a company becomes dependent on approvals from a foreign government, the relationship changes. Suddenly, there are informal expectations. Perhaps a technology transfer would facilitate smoother export approvals. Perhaps a joint venture with a Chinese partner would demonstrate good faith. Perhaps relocating certain manufacturing operations to China would ensure long-term supply security. None of this is stated explicitly. It does not need to be. The mechanism is already in place. Companies that need silver will find ways to accommodate the gatekeeper. Those that do not will find themselves waiting. The clean energy transition, which Western governments have championed as a path to energy independence and climate action, has an ironic vulnerability. It runs on materials controlled by a rival power. Solar panel manufacturers in Germany, electric vehicle producers in the United States, and battery makers in Japan all depend on silver supply that flows through Chinese refineries. If those refineries slow output, if export approvals take longer to process, if shipments are delayed for quality inspections, the entire transition slows, not because the technology failed, not because demand disappeared, but because the materials required to build the future are controlled by someone else. The defense industry faces an even more acute problem. Military systems cannot afford supply chain uncertainty. A missile guidance system that requires silver cannot be redesigned on short notice. A radar array that depends on silver's conductivity cannot switch to copper without years of testing and validation. Defense contractors need reliable supply, and reliability is exactly what export controls undermine. There are no hard figures on how much silver the defense sector consumes. The data is classified for obvious reasons, but analysts who study materials flows describe the usage as significant. And in defense applications, significant means mission critical. China has told the world something important with these export controls, and the message was not complicated. Silver is no longer just a commodity traded on exchanges. It is now a strategic asset in a resource war that most people do not realize is being fought. Wars today are not fought primarily with tanks and aircraft carriers. They are fought with supply chains, export licenses, technology standards, and resource control. The battlefields are regulatory offices, refining facilities, and shipping terminals. And the weapons are permissions, delays, and dependencies. Charlie Garcia, writing in his analysis of the situation, made the point clearly. Beijing is not restricting exports because the government is worried about speculation. China is restricting exports because it needs the silver and has figured out something that Washington has not. The clean energy transition runs on metals, and whoever controls the metals controls the transition. The implications for investors are profound. Physical silver, held outside the banking system, represents something that cannot be manipulated by export approvals. There is no counterparty risk when the metal sits in a vault or safe. There are no margin calls. There are no frozen accounts. There is just silver, sitting quietly, appreciating in value while bureaucrats in Beijing shuffle export applications into the pending pile. This is why physical demand for silver has surged in recent months. Investors who understand geopolitics are recognizing what is happening. They are moving assets out of paper claims and into physical metal. Because paper silver, traded on exchanges and held in ETFs, is still subject to the same supply chain vulnerabilities as industrial users, but a 1-ounce silver coin in hand is not. The $100 per ounce price target, which seemed ambitious just months ago, now appears conservative. Some analysts are projecting $134 per ounce as the threshold where solar demand begins to falter. Others believe prices could move even higher if geopolitical tensions escalate or if China tightens export controls further. But the price target, while important, is not the central issue. The central issue is control, and control is shifting from markets to governments, from buyers to gatekeepers, from the west to the east. The United States and its allies are beginning to respond. Silver has been designated a critical mineral. Domestic mining projects are being fast-tracked. Refining capacity is being discussed. But all of these responses face the same obstacle that has plagued every attempt to counter Chinese resource dominance: time. Building a mine takes 2 decades. Building a refinery takes years. Securing permits, financing projects, constructing facilities, training workers, establishing supply chains. None of this happens quickly. And while the West plans, China acts. The rare earth metals crisis taught a clear lesson. By the time Western nations realized they had a problem, the solution was a generation away. The same pattern is now unfolding with silver. Recognition is growing, but recognition without rapid, decisive action is merely awareness of a problem that cannot be solved in time. For the business community, for investors, for anyone whose livelihood depends on industrial supply chains or monetary stability, the message is unavoidable. Silver is no longer simply a metal. It is a strategic asset in a contest for economic dominance. And that contest is not theoretical. It is not a future risk. It is happening now. Those who position themselves accordingly, who understand that physical silver represents insulation from geopolitical leverage, will benefit from the scarcity that is now baked into the market structure. And those who ignore the shift, who assume that markets will self-correct or that supply will magically increase, will find themselves negotiating from a position of weakness. Beijing has built the architecture of control. The licensing is in place. The leverage is established. And the world is only beginning to understand what it means. The battle for silver is not coming. It has already begun. And in this battle, holding the physical asset is not just an investment decision. It is a strategic necessity.